Good afternoon, everyone. Today I'm going to talk about my portfolio and the changes that have happened so far. If you watch my previous videos, nothing's really changed. I'm still waiting for the August 2nd SOFI calls to expire. So it's either going to be that I'm going to wait until next Friday for it to fully expire, and then I'll go ahead and cash out. So another way of saying that is I'll be rewarded the full set of premium, and then I'll also have my shares exercised away, right? So or called away from me. So that said, that's what I'm looking for. Earnings is going to be on Tuesday morning. So what's really going to be nice about that is I might still be able to play other company earnings in the meantime. One strategy I've been thinking of is right now I can't really get out of this position without essentially not gaining any money. So as you can see right now I'm at 52K. I started Monday at 52K. So if I were to have exited on Friday or Thursday, I would have pretty much been in the same position, which is not like, which means a week's worth of movement, I would have gained nothing. So in that case, it didn't make sense for me to exit out early and get into something else. However, after earnings on Tuesday morning, I do believe that that's when either Tuesday or definitely by Wednesday, the volatility of this week's set of options decreases just because earnings is done. And so what that means is we should see these options kind of go to not zero necessarily, because it's just going to be whatever price such that the extrinsic value is pretty much zero. So the extrinsic value would be zero, but the intrinsic value is always the intrinsic value. I know that's a lot of terms, but it essentially just means that, like, let's say I had a $5 call and the stock here is here at 741, then it would be $2.41. So it would be whatever money it is to match that price, maybe an extra cent. So you might see $2.42. Now, in this case, this $6.50 call, in order for its extrinsic value to be zero, it would be whatever this price is plus, like, let's say a penny. So it would be 92 cents, 92 cents. So once this gets to 92 cents, right, in this example, then it would be fully, for the most part, just worth 1 cent. I could buy it back for a cent a piece. I have 190 of these. I can buy them back all for $190. They paid me roughly 2,500, so I would net profit 23. So that's what I'm looking to do either on Tuesday or Wednesday. As you can see with covered calls, there's not really anything exciting about it unless you get a huge price movement, or after the volatility event, such as earnings, or let's say like a Fed rate meeting, whether they're going to cut rates or increase rates. That's another point of volatility. Another one is like the election, for example. So all of these cases where there's moments of high volatility, once it's passed, then you can do what it is you need to do, which is either like cash out or um, usually you can just cash out because the options are going to be worth a lot less. You could wait out that last extra bit of premium, but why? Because it's worth very little. You could just go into something else, or you could sell a different call and make more money that way. At least that's from my perspective, not financial advice. Um, so that's what I'll be looking to do. One thing is, on Thursday, I was really excited about the prices. As you can see on Friday, everything went up a little bit for some companies, more so than others. But that said, I was really attracted to Starbucks. If you watch my previous videos, you know that 2 weeks ago, or yeah, not this past week, sorry, a week ago, I was able to make a quick 2K off of it. And that was during this price movement right here. So essentially, I'd have bought it at 780. It there was news about an investor who had gotten in, and it jumped up to 79. I had some covered calls on it, and I was able to cash out early. That was pure luck, right? So I was just gonna wait until 8/2, or August 2nd, and then I had sold, I think, $75 calls on it for like 4K. But like I said, I was able to exit out for half the price. On Thursday, when it had gone down to $73, I was really, really tempted to exit my SoFi position, even at $0 profit, and get back into Starbucks, because I would be able to get back into Starbucks at a lower price. I would still be able to sell covered calls, and I do like Starbucks. It does look like a pretty good company, in the sense that it's pretty strong, has a strong balance sheet. It also missed last quarter. That's why it's really punished right now. but it looks like it's expected to go back, and I think that's when it'll be rewarded. So one of my plays is, since this is July 30th after hours, I'm really hoping that the SoFi uh, calls, the option premiums pretty much go down to almost like 1 cent. That way I could make my profit, sell out, and then get into Starbucks if it's still low by Tuesday. So then Tuesday after hours, then I could just hold on to Starbucks and gain tons of profit just for that one day. So that's kind of the plan. But who knows if Starbucks just doesn't skyrocket by Tuesday? I don't know. So if Starbucks were to go, I'd say like to $76 and above by Tuesday, then I wouldn't really get into it. But if it were to stay low around the $74 range, $73 range, or would be nicer is even lower than that, then of course I'll jump out of SoFi and then get into Starbucks once I collected my SoFi premium. So those are some just like kind of plays that I have in mind. And then for the next video that I'll be posting, it'll just be what companies I think are pretty good price, or like what companies I've been eyeing and what I've been thinking about getting into, but I haven't yet gotten into because like I said, I'm in a pretty comfortable position. As long as SoFi stays above 650, I'll be able to collect my premium. And it's looking pretty safe, if you notice. For all the SoFi bulls out there, you're probably kind of happy that it's pretty happy that it's been holding its gains. As you remember, a month ago, it was down to its 52-week lows, hit about $8. And since then, it's been stabilized around 750, right? Like 740, 750. So as long as it stays around there, then I'm in a good position. I'm going to get paid out because it'll still be above 650. If it does drop all the way down to 650, that'll be really good, and I'll be really excited to stay in SoFi instead of Starbucks. But if SoFi stays around 750, I'll get out of SoFi for now, and then I'll just get into Starbucks. If Starbucks is down, and like I said, it just kind of goes. You have to go with the flow as far as what's a good price. So there's tons of good companies out there, but what is a good price to pay for it? Those two together, at least for me, is what determines what stocks he should be in, or what stocks I should be in, because it's, you want to buy a solid company at a good price, and that's pretty much what it comes down to. And then even further, you could sell insurance on it, which is covered calls.